ideas are great, plans are great, but there's nothing like a good chunk of money to help your idea really take off and really be successful. So this is one of the first ones that we do in terms of venture capital. So I'm very happy. Thanks, Nick, for doing this. I'm looking forward to see what you have in place for us.
Great. Thanks so much for having me, Furman. Appreciate it.
Thank you.
Okay. Welcome, everyone. I appreciate you coming out amidst the rain. So who in the room has a startup currently or has started a company in the past? Show of hands. Okay. All right. You're in the right place then. This is all about startups, and this is all about raising capital for startups. So if you're planning on raising capital, if you're intending on starting a business and getting venture funded, then you've come to the right spot. So we're going to talk about how to raise capital from VCs and angel investors today. We'll go through a variety of different modules. This is part one of a two-part series here. And we're going to start out with the strategy and the fundamentals on fundraising. That'll be the first module we go deep on today. Then we transition to the materials that are required. We're going to go through those in depth. And we'll finish up today with how to build your funnel. So creating that investor funnel just as if you're a salesperson, just as if you're a BD professional that's trying to close on a sale. We're going to approach fundraising the same way. So that's today. All right, who is this a fit for? And who's it not a fit for? If you're raising in the next 3 to 6 months, this is a good spot for you to be. And these are good materials for you to be processing and driving through right now. If you're outside of the Bay Area, this is also a good fit for you, as well as New York City. So the Bay Area and New York City have some interesting dynamics, interesting fundraising climate that some of these materials will be appropriate for, but this presentation is really designed for folks that are outside of San Francisco. Also, if you have not raised more than $5 million previously, if you're a first-time founder, if you've created your first prototype or MVP, minimum viable product, this is a good fit. And if you desire to spend the next 10 years of your life working on the problem at hand. That's an important distinction here. If you're not committed enough going in to spend the next decade of your life on the problem at hand, you should probably find a new problem to address. Or if you don't have one, maybe go work on something with somebody else or work for another company that's pursuing a mission that you're passionate about. While you find that idea, while you find what you're really passionate or obsessive about. By the way, we are going to review a number of different concepts, language, different semantics like MVP here. If things come up that you're not familiar with, just write them down. And at the end of the modules, we'll go through a Q&A, and we'll give you guys an opportunity to ask those questions. If we don't get to your questions, because there's a ton of material to get through in 2 hours, then Google it. Most of these things are very easy to find with just a simple Google search. All right, who's this not a fit for? Well, if you're trying to close capital within the next few weeks, this is really not the place for you to be. I would expect that you've already done the majority of what's in this presentation, and you're very close to negotiating and closing agreements with angel investors or VCs if you're planning on closing within weeks. This is a long-term approach. These are relationships that are going to last for the duration of your startup, 10 years in some cases. Fred Wilson, one of the most famous VCs in the country, just wrote a blog post this past week called The Long Engagement, which is really about that dating period before you commence an agreement with investors. It's really important that you get to know who you're taking money from before you take that money, and they get to know you. It's an important relationship. Also, as we discussed, if you're based in SF, much of this presentation won't be designed for you. If you've got a $100 million plus exit or you've raised a ton of capital in the past, you probably have a good handle on most of what's in this presentation. And if you've been in leadership at a unicorn tech company, if you've been a core contributor, a senior engineer, for instance, at a tech company that's well-funded, maybe attaining unicorn status, a lot of this won't apply to you because the fundraising rules just go out the window if you're one of these entrepreneurs that has had a huge exit, or if you've been in senior leadership at a place like Google or Snap or Facebook, et cetera. And finally, if you're just doing this to try and build your personal brand, if you're going out and raising from angels and VCs to kind of get in the spotlight and exploit the hype and have some fun, this is not the place for you to be. This is for professionals, people that are launching startups and planning to do this professionally, intentionally, obsessively for a long time. All right, who am I and who is NewStack? My name is Nick Moran, as Furman introduced. I started out as a developer after college. So I learned to code in about 8 different languages when I was in undergrad. I moved into mergers and acquisitions. I went back to school, got a business degree, became a transactional person that was pursuing a variety of different companies that fit within a strategic portfolio that I could acquire. Subsequently, I transitioned into product management, which is sort of the entrepreneurial role for a company, right? You're starting with ideas, you're starting with a hypothesis, you're going out to customers, validating that hypothesis, you're working with engineers and scientists, and you're creating a product from scratch. And even in my case, there was fundraising involved. And finally, I became an investor full-time for myself. First an angel, subsequently venture capitalist. I also, some of you may know this, I created the first and largest venture capital focused podcast. It's called The Full Ratchet. I lead the largest AngelList syndicate based in the Midwest. I think it's the largest angel group, formal organized angel group in the Midwest. It's about 650 folks. That includes angels and family offices. And I also founded the venture firm NewStack Ventures, which is right here. We're a Chicago-based $6 million seed fund. We are the only seed stage focused IoT and hardware fund between the coasts, to my knowledge. I know a lot of different VCs across the country on both coasts as well as between the coasts. There are people that will dabble in IoT and hardware and will co-invest, but I believe we're the only person that actively leads seed deals. We've deployed about $4.5 million. We have 20 portfolio companies. We have one of the highest follow-on rates of all syndicates on AngelList. So there are hundreds, if not thousands, of syndicates on AngelList, most of which are based in San Francisco. I think we're ranked number 2 currently of all. And we make 400K investments, approximately 400K investments in startups. First check, pre-seed investors. All right, module number 1, the fundraise fundamentals. Let's talk strategy. All right, so the first step here is, should you raise capital? All right, we're going to go deep on whether it's a fit or not. Then we're going to talk about if you're ready to raise capital. Okay, so the first step is, should I raise? Second step is, am I ready to raise? And finally, who to target. All right, so should you raise venture capital? Venture capital is probably not a fit for you if you run a lifestyle business. This is a business where you make maybe healthy revenues. It's not scalable. It's not a business that's going to be a global brand. Maybe it's not a tech company. It's a lifestyle business that allows you to lead a comfortable life. Maybe it produces a steady income, but it doesn't have that potential to go big. It's not for venture capital. VCs are very interested in what we call binary outcomes. They want ones and zeros. A 1 is a huge success, unicorn success, billion-dollar exit, right? A 0 is a failure. VCs actually pursue both failures and huge exits. They want to see zeros and they want to see massive returns. They don't want to see a lot of mediocre, modest, single-digit multiple returns. So like 3x to 5x returns in the portfolio, that's not what a VC is pursuing. They want 20x, 50x, 100x. In the case of a company like Uber, 1,000x or 10,000x returns, right? So $1 into Uber, potential for $10,000 back. That's what VCs are looking for. What else? If it's a localized business. So if you start up something that's local to Chicago, for instance, maybe it's a storefront, maybe it's retail, right? You have a new hipster, cool clothing retailer that's really hot, really exciting, but your plan is to focus on Chicago only. It's a Chicago style, maybe, and there's no plans to expand beyond the local region. If it's just a local business, it's not going to be a fit for VC. If you're a part-timer, right? So if you're kind of working another job, or you're doing some consulting, or you're doing some programming on the side, maybe some NRE contracts, this is not a fit for you. Now that being said, you can be part-time when you start the capital raising process and when you start your business. That's actually a smart move. Make some money at your full-time job, work on this on nights and weekends. The famous saying in the Valley is, if you want to find out what the hot trend is next, find out what the Google engineers are doing on nights and weekends, okay? So that's a good place to start. But as soon as you close that first round of institutional capital, you need to be ready to resign and move on to a full-time endeavor with your startup. So don't plan on doing this sort of thing part-time if you're raising institutional capital. Next, if you have a service-based company, this is different than SaaS. SaaS stands for Software as a Service. Many of you folks probably are familiar with SaaS. It's been one of the hottest categories for funding within venture capital over the past 5 years. This is different. Service-based is more consultancies, right? So any business that's heavily dependent on the people involved, like our business, actually. As venture capitalists, we're not venture fundable. Other VCs don't want to invest in us because we don't have that potential for 1,000x returns. Because our little group of 8 folks on our team, it's very people-oriented. The people are the business. So we are not venture fundable. We are a financial services company. Service, yeah? So service-based businesses, consultancies, dev shops, et cetera, that are very people-centric, not fundable. VCs are looking for product-centric businesses or technology-centric businesses that can scale. All right, if you're going it alone, you can have success, but it's much more difficult, right? Most investors are going to be looking for founding teams that have a well-rounded profile. Often we call it the builder and the seller. There needs to be somebody on the team that can build the product and build the technology. There needs to be somebody on the team that can sell it, create relationships, get out into the market, tell the story, explain the vision. So often you need to have these dynamic teams of multidisciplinary folks in order to have success. And it's very rare that you find a single founder business where that single founder is good at everything. They can do the marketing, they can do the sales, they can do the fundraising, they can do leadership, they can do development. It's hard to find that in one person. So if you're a single founder, it's a good idea to be thinking about what you're good at, where your weaknesses are, and how can you network and expand your reach of folks to find somebody that would be a really good partner. And then finally, if you must outsource the core technology, probably not a good fit. Most VCs are looking for businesses where the core tech and the core product can be built in-house. Now, if there's extraneous technology, or technology that maybe isn't core to the central vision, but is important, that can be outsourced. So if I were to give you a quick example, we invested in a local company here called GeoBit. Does anyone know what GeoBit is? Okay, got a couple people in the room. It tracks kids. There you go. All right, so GeoBit is a small child tracker. It's a hardware device, right? You can put it on the belt loop of a child. You can put it on the collar of a dog. And as soon as the dog leaves your yard, you get a notification on your phone. If your child walks to school and takes the same route every day, as soon as they wander from that route, you get a notification. And you can track people in real time. So GeoBit did some really fantastic things with technology and battery optimization to make this a popular product. And they've raised tremendous amounts of capital beyond when we invested. However, they could outsource maybe the app, right? Their core technology is in the hardware device, is in power management, is in GPS tracking. Maybe the app interface is not the core technology, so the app could be outsourced. Or maybe the website. The website's important to what they're doing, but they could, in theory, have outsourced the website development because it wasn't core, it wasn't central to what they were building, it wasn't part of their differentiation. So think about that. If your core tech you need to outsource, probably not going to be a good fit for venture capital. All right, key considerations before you go out and raise. This is not a one-time event. Your first institutional raise, so when you raise from somebody like me, that starts the clock, all right? And every 12 to 18 months, you're probably going to be raising another round of capital. So be ready to become a capital raising guru for a living. That's what you're going to do for a solid, 6 to 8 years if you don't get an early exit. You're going to always be raising. It's kind of like that scene from Glengarry Glen Ross with Alec Baldwin where he says, always be selling. If you're a founder of a venture-backed company, you're always going to be raising. So be ready for that. And as soon as you take capital, you start the clock. So if you miss that next subsequent raise in 12 to 18 months, people are going to start looking at you as a zombie company instead of a company that's trending in the right direction. The second key consideration here is you're relinquishing equity and control. So when you take money from venture capitalists, clearly you're selling equity. You are selling a portion of your company. I think we all know that. But you're also giving up a degree of control. Maybe not in every round, but as you build out a board of directors, as you get more investors on your cap table, your ownership table, capitalization table, you will be giving up control of your company. Other people will have a vote and a say in the long-term strategic vision of your company, in the management of your company. I've been in situations where founders that we invested in are actively being replaced by later stage VCs because VCs think that they can bring in a management team that's better. So be prepared that you will lose some control, and if you partner with the wrong sorts of folks along this journey, they may replace you. And finally, most investors desire binary outcomes. We talked about this. They want to see the tail of the outcomes, not the middle of the distribution. They want to see huge, massive exits and zeros. Okay, are you ready? Let's talk about why investors pass. All right, this is a good exercise to go through to understand how you need to be prepared before you go out and raise money. The first three reasons here are more the reasons here on this slide are more investor driven. So investors may tell you that they have a liquidity issue, which means they don't have cash on hand to invest. Maybe their cash is tied up in other investments that are long-term in nature. So they might really like you, they might really like your business, but they don't have cash on hand to invest at the moment. You'll also hear investors saying, oh, I don't have time to review. Maybe your round's coming together, maybe you need to raise in the next month, and for whatever reason, the investor's too busy, they've got something going on, they have vacations, they have family events, they have business events, etc. They don't have time to review. Another reason why investors might pass is because they were burned on recent investments. You'll see this often. Investors make a lot of big swings, particularly angels. A lot of angel investors aren't professional in the way they approach this, so they might take a little too much risk. They get burned on a couple investments, those investments go to zero, and all of a sudden, angels get cold feet. I'm out of here, this is not working out well. I invested a ton of money in 3 startups, and all of them went to zero. This is an asset class that's terrible, you can't get returns in this asset class. That couldn't be further from the truth, but angels need to diversify. This is a very risky space. And then finally, you're going to hear this term, not a fit. Not a fit, right? We hear this all the time. You're not a fit for what we're doing. Sometimes it's true, right? Like if we're an IoT, hardware-focused venture capitalist doing seed stage deals and pre-seed deals outside of the valley, and a startup founder reaches out to me with a really compelling opportunity, a good deck, but it's San Francisco based. They're raising a Series A round beyond where we invest, right? And let's say it's B2B enterprise software, right? All 3 of those things are off of our focus area, right? We can dabble a little bit if maybe one of those 3 things is off of our focus, but if all of those things are away from what we do, it's clearly not a fit for us as a venture capitalist. But this is also used as a cop-out reason, right? When an investor doesn't want to communicate the real reasons why they don't want to invest. Or maybe they don't know how to articulate it. They just don't understand the opportunity. They don't quite get it. It doesn't resonate with them. They're just going to tell you it's not a fit. But there's a lot of reasons behind that not a fit that we can get into. So there are startup-driven reasons as well. So business reasons that have to do with your company that we can jump into and are reasons why investors pass. You're going to hear about these 4 categories that every investor reviews: the product, the market, the team, and the traction. Those are kind of the 4 high-level things that everyone's looking for. You're going to want to optimize around all 4 of those items. And so we're going to take a moment, and I want you to huddle up with people around you. Let's try and do groups of 3. So find 3 people nearby you, and we're going to do a quick brainstorm. The first segment is product. So product and business strategy. I want you to come up with reasons why an investor may say no based on your product or your business strategy. Come up with 3 to 5. Write them down on a sheet of paper. I'm going to give you 5 minutes, and then we're going to come back. Take your time, guys. All right. Good job. Appreciate it. Let's go through some of the reasons you came up with. So I'm going to start with this group in the front. We'll just go counterclockwise here. Give us 3 of the reasons you came up with. Scalability. Okay.
And then regulatory.
Regulatory. Good.
Competition.
Competition.
Team competence.
Timing. Good. How about in the back of the room? Thoughts?
We have like if it's unrealistic or the product overall is broken and not working, would be really hard to invest in.
Okay. JR, give me a reason.
This is a little unfair because I'm part of New Stack, but consumer-based product.
Consumer. Some investors will pass.
Is that what you mean? B2C company?
B2C. This is B2C. Many investors, actually, probably 80% of investors will pass just because it's consumer. Other thoughts over here.
A poor revenue model.
Okay. Good. How about up front?
I guess poor initial traction with other investors, with other people in that particular business line.
Good. All right. I mean, that's a good starter list. I'm going to give you some more that I came up with. And these are non-exhaustive. But let's say you lack a near-term beachhead. Investors may call this a beachhead. They may call it a wedge. They may call it a killer app, right? What's the near-term opportunity for your product, for your business? I define the beachhead in 3 different branches. What's the niche customer set? What is a very defined, narrow definition of your product? And what is the application of your product? Those are the 3 branches to my beachhead, the way that we look at it as a firm. If you don't have a near-term niche that you're trying to exploit, driving that wedge, you know, it's a military analogy. You can get traction, you can get progress within this very defined, narrow group. That provides access to do much more later. But if you don't have that defined, if that's not a part of your strategy, if you're just trying to go out and sell it to everybody, you know, every type of consumer, no definition around the demographics or the psychographics or who they are, why they buy, not a good idea. Also, lack of a large vision. So we just talked about the narrow vision. That's like the 1-year target. The large vision is more of the 5-year target. In market parlance, we'd call this the TAM, right? So you need to have a large vision. So narrow near term, large long term. All right, also lack of clarity of the key stakeholders. Who are the buyers? Who are the users? Who are the channel partners? Who are the suppliers? You need an awareness of the entire market and who the players are. If you don't have that awareness and you're asked those questions in an investor meeting, it's not going to look so good. Also, a roadmap. You need a product roadmap. And for those of you taking photos of the slide, like these slides will be provided, so don't worry, you'll get all these slides after the presentation. Product roadmap. What does that mean? That means, what is the product today? What is the product going to be next year? What's it going to be in 2 years, 3 years, 5 years? Right? How will the product evolve over time? You need to be thinking through those things and where it could go and what it might do, even if you don't have all the answers today. Also, we talked about business models. Somebody came up with that one. No recurring revenue model. No ongoing value exchange with the customer. You remember, for some of you older folks in the room, when you went to Best Buy 10 years ago and you went to buy Microsoft Office or maybe the most recent game that comes out, we called that shelfware, right? You bought it off the shelf, you gave your money, and that was the end of the value exchange between the consumer and the company, right? That's the end. Whereas now, the value exchange is perpetual, right? We have all these recurring revenue models. You don't transfer money once up front, you transfer money on an ongoing subscription basis, often a monthly basis. And what that does is it encourages the company, i.e. the startup, in your case, to continue providing value. As soon as you stop providing value, as soon as your game isn't current, as soon as Microsoft Office isn't providing the value and you're moving to Google Sheets, you cut off your subscription. So it actually puts the right sort of value-based pressure on you, the startup, to continue creating value and more value so that you can command revenue for it. Also, incremental spend versus existing budget line items. That's something you should think about with enterprise customers. Anytime you're selling to the enterprise, a B2B model, you want to be thinking, are they already paying for something in this budget category, or is it a brand new spend item that you're introducing? If it's brand new, it's very difficult. And finally, lack of float. Float was cited, I think Warren Buffett called it out as, or maybe it was Charlie Munger, called it out as one of the most unappreciated factors in investing. And float really means working capital, right? Accounts payable. So are you able to capture revenue in advance for something, or do you have to give away a ton of value far in advance of getting paid for it? So think about working capital, that's float. And that's not it, we got more. Lack of a defensible moat. Who's heard the term moat before? Who knows what it means?
Just having like a barrier around you so that people can't sort of come into your space and can't like compete with your product.
Perfect. Having a barrier around you so people can't come into your space and compete, right? A moat is defensibility. There are all different types of moats. The most traditional that most people think about is intellectual property, right? Having a patent, right? That's a form of defensibility. But there are many different forms. There are network effects. There are a lot of ways that you can create a defensible position that other people can't copy. Also, lack of a user acquisition edge. At Newstack, we call this BD innovation. That's one of the themes we invest around. But how do you have an edge? How do you have an unfair advantage when it comes to acquiring customers that nobody else has, right? The best of the best come up with a way that they can acquire customers in a different way that other people can. The age-old, oh, we're just going to buy traffic on Facebook. We're just going to use paid ads. It's not great, right? We don't want to hear that. If you have to buy all of your traffic, how can you create an unfair advantage when it comes to user acquisition? Be thinking about that. Network effects, if you don't know what that is, Google it. It's very important. A lack of virality. Virality is the likelihood that your customers tell other people, other potential customers, and it can explode because your customers become an extension of your sales force or your marketing organization. Low NPS score and or growth within existing customers. NPS, Net Promoter Score. It's probably the most important, arguably top 3 most important metric to be tracking at any business. Startups, enterprise, large companies, Net Promoter Score. It's effectively measuring how likely is it that your customers will recommend your product to a friend. In some cases, we see technologies and solutions that are looking for a problem. So they develop this great tech. Oh, we did this amazing new thing. Now we're just trying to figure out what to do with it, right? That's going back to finding this killer app. When lasers first came out, this is like 25 more years ago, right? Lasers first came out. They were like, wow, what are we going to be able to do with these lasers? All these companies started and flamed out using laser-based technology. Does anyone know what the killer app for lasers was? Close. That came later. Think grocery store. Scanning. Scanning your groceries at the grocery store was the killer app that caused laser technology to take off and be used in a variety of different capacities. But that was the killer app for lasers. All right, we've also got capital intensity. So some businesses, like I got a pitch for a guy that was trying to build a bridge to the moon. Pretty ambitious, right? 20-year plan. What are we really doing here? What's the importance of a bridge to the moon? He had some theories. It was kind of interesting. I heard another pitch from a friend of mine that was trying to do advertising on the moon. So you look up on the moon and you see a big advertisement. I mean, very ambitious stuff. A very well-funded company called Planetary Resources is trying to mine asteroids, right? So they have like a 50-year vision, but they're trying to send, ships into space, dock on an asteroid, and mine like very high-value raw materials. I mean, crazy stuff, right? But the capital intensity is off the charts for some of these things, and it's hard often just to get past go if the amount of capital involved in just starting is crazy. Hardware businesses. So even though we invest in hardware, we're in the vast minority, maybe less than 10%. Could be less than 5% of total investors. I'd have to ask some of my colleagues that have worked on this, but hardware is scary to many investors. If you have single channel exposure, we call this channel choke. So we recently saw a business that was doing this really great power tool for Amazon. So anyone that was a seller on Amazon, selling things, on Amazon.com, this tool really empowered what they were doing. What's the problem with that? Anybody know? Everybody can have it. That's a good one.
Amazon could change their strategy and choke you off.
Perfect. Amazon could change their strategy and choke you off, right? If your channel, if your access to customers is single, right? Like Amazon or just Facebook or just Twitter, that's the only way we have access to customers, they can shut you off in a day, and it's over. Channel choke, bad or inappropriate business models. We talked about that. If you're starting a business that should be a subscription company, but maybe you're charging an upfront fee, right? If it's misalignment between the business model and the company. And then finally, timing. Somebody hit on that. Timing is critical. Maybe the technology isn't in place. It's just not ready for the business. Before Instacart, there was, I think it was Shopvan. Is that right? Webvan.
Oh, yeah.
Before Instacart, there was Webvan. Before there was Uber, there was a number of people trying to do decentralized mobility through cab companies and whatnot. Before the proliferation of iPhones or smartphones in general, a lot of these things just were too hard to pull off. And so technology is a big enabler that allows things to happen. Okay, we're going to do another quick breakout session. I want you to do the next 3. So think of market reasons, team reasons, and traction reasons. Why investors might pass. We're just going to take 5 minutes, so pick up the pace on this one. But come up with a couple reasons for each. Market-based reasons investors might pass, team or talent-based reasons investors might pass, and traction-based reasons. All right, 5 minutes. All right, 30 more seconds, guys. 30 more seconds. Okay, guys, let's debrief on this brainstorm. So reasons why investors pass, market-based reasons. And we're going to start in the front of the room. We're going to go around clockwise this time. So market-based reasons.
Market's too small.
Too small. Good.
The market's just a fad.
It's a fad. Good.
Maybe the market is shrinking, like we're on the tail end.
Shrinking. Good.
Too saturated.
Saturated. Excellent.
Doesn't exist yet.
Doesn't exist yet. Okay, interesting. Some investors will use that as a reason to invest. Did we get every group for that? Okay, market reasons. Very good. Team reasons. Let's start up here again.
The experience level of the founders.
Experience. Diversity. Did you have one?
Actually, it was the same thing,
Not enough experience, yep.
the composition, so you have too many different ideas, people, but not execution oriented, so it's the balance of
Excellent. Composition, balance of skills.
Let's cover ours.
Okay?
Internal conflict.
Conflicts?
Yeah, good clash of personalities.
Oh, interesting. Internal conflicts.
Too many cooks.
That's a great one. That's actually the reason for the death of a lot of startups. Others. How about over here? Lack of hustle. Up front? Covered it? Okay.
I do have another one. It's like if the VC will not like the team personally on the personal level.
Okay. So lack personal fit, charm. Okay.
It's really reasonable, but still it exists, right?
It exists. You can. I mean, I certainly have meetings where it's not a personality fit, and with other investors, it is.
And an issue about coachability, not willing to take advice, potentially pivot.
Coachability. Excellent. Okay, let's move on to traction. Let's start up front again.
Minimal traction.
Minimal what? What kind of traction?
Monetary traction.
Okay, dollars. Revenue.
Yeah, customers not.
Yeah, minimal customers. Good.
What traction is expected at pre-seed IoT from your perspective?
We'll go over that. We're getting there. You're ahead of me. Who asked that? Good. Very good. Other reasons they pass, traction based.
I mean, I guess when you're a customer, I mean, when whoever you call your customer, they're using you, but they don't really care so much that they want to pay for it or that they sort of are pushing for you.
Customers don't care.
Exposure issues.
What? Explain.
Exposure, in the mainstream media.
Lack of exposure?
Yeah,
That's good. That's really good.
I'd add like the, how many customers are renewing, like after they're buying, is this something that they're seeing success with and they want to come back for more? Sure.
Renewing, or let's say maybe growing your basket with customers. Does anyone know what VCs refer to that as? Anyone? Recurring is close, but not just the same amount of recurring.
Lifetime value.
What happens when it goes up? We call that expansion. Expansion revenue. Excellent, excellent one. Okay, good list. Good list for traction. Let's go through some of these quickly. I don't think we can get to all of them, but we did product. Market. Here again, it's a market that's service-based. It's not scalable. It's a localized market. Somebody mentioned consumer. right? There are many investors that will not invest in consumer-focused startups, B2C, right? They exclusively do B2B. There are regulatory. Somebody brought that up. That was a great one. Regulatory concerns with the market that could present issues, right? Regulatory changes could come about that could limit the market or remove the market altogether. We have shrinking or small market, so it's not an attractive growth market. You guys came up with that one. And then we talked about creation of new markets. That's often something that's really interesting to VCs. VCs refer to this often as either disruption or competing with non-consumption. They're not exactly the same things, but they're related. VCs often want to see you not only exploiting existing markets, but creating brand new markets, right? If you can differentiate your product, if you can charge a much lower price, if you can do something much more focused, you can often create brand new markets. No clear articulation of the SOM, SAM, and TAM. We're going to go over this later in the pitch deck, but these are the 3 different types of markets that you need a handle on. The SOM is kind of your 1-year target, the SAM is your 3-year target, and the TAM is your 5-year target. These are the 3 different types of markets you need to be thinking about going out after, and if you can't articulate that, bad news. Again, we talked about the beachhead and the vision before, but if you have a great SOM and SAM, but your TAM is very limited, your vision, your upside is small, not good. Some VCs want monopolistic markets. They want winner take all. They want to go after markets where there's a huge moat, there's tons of defensibility, and whoever gets that first mover advantage, whoever gets into the market and establishes themselves, like an Amazon, for instance, it's going to be really, really hard to disrupt that and take them out. So they want those. And then finally, timing, which we talked about. In some cases, markets and customers just aren't ready. All right, team, there's probably too many to go through here. All right, but you're going to get this deck, and you can go through each of these items. But there are many team-based reasons to pass. You know, people are poor communicators or single founders. Or they don't have the right experience. They don't have domain expertise in what they're going after. They're arrogant. The deck is cluttered. It's unclear. Their thinking is muddled. Founders that aren't co-located, right? They're not located in the same space. They're not located in the same city. Now, some investors will invest, no problem. We invested in a company recently called TripScout, where one founder is located in Chicago, another founder is located in Washington, D.C. And they have great experience handling remote teams, and we did not see that as an issue. But there are many investors out there that will not invest in businesses where the teams are located in different areas. Also, people that kind of go in with broker-dealers, that's kind of a big no-no with institutional investors. If we sniff out that there's a broker on the deal, a lot of VCs back away. If you have an LLC structure, not good. You should probably be migrating to a C Corp, which isn't difficult to do. Often it's just not a stage fit, right? The progress of the company doesn't match what you're going after, right? We'll have founders that show up on our doorstep say, yeah, I'm raising 3 to 5 million. How much progress do you have? Well, we got an MVP. We don't have any revenue. We don't have any users. And I'm going, whoa, have you thought about maybe raising 50, 100K, like getting some traction, showing some progress, and then going out for more capital? So you can see there's a lot of just misalignment. You can read through all these, but if you're unrealistic or you're desperate or you lack decision-making clarity, you know, you're going to get into trouble. All right, let's talk about traction. So we hit on a bunch of these. Insufficient revenue traction or pre-revenue, right? In a lot of cases, investors won't touch you. We will. We invest pre-revenue. We've done a number of those deals, but a lot of investors won't. Insufficient user traction, right? So there are businesses that are designed not for revenue at the beginning. They're designed to acquire users, right? Facebook didn't turn on revenue until after they acquired Instagram, I believe. It was a long time that Facebook was operating without any revenue from ads. And as soon as they turned it on, they jumped. But they built what we would call in the VC industry the zeitgeist first. They built a product and a community and a platform that people loved and they became addicted to it. And once they had all these users captive in the platform, they were able to flip on monetization. Low growth rates, right? High churn rates. Customers are leaving. The leaky funnel. We talk about this a lot in VC. That's when you can acquire customers, no problem. You have a machine for customer acquisition, but you can't retain any customers. Customers just fall out the bottom of the funnel. A classic example of this was Blue Apron, which IPO'd and had a lot of success in the private markets, not much success in the public markets, because they're great at acquiring customers. Everybody believes in the promise of easy dinner. Delicious, healthy, easy dinner. And then they start subscribing to Blue Apron, and they're like, shoot, this is a lot of work, right? And they leak right out. They discontinue. We made an investment, a competitive investment to Blue Apron that we think does an amazing job of addressing the leaky funnel problem. That startup is called Tavala. Traction needs to match the investor stage. We talked about that. Some of these metrics you can look up, like expansion revenue, net new MRR, monthly recurring revenue. Also customer concentration. If you're a startup that has one customer, we're doing all this revenue, but you just have one customer, that can be seen as a huge risk to a venture capitalist. Well, what if that customer leaves, right? Or why have you not been able to secure more customers than just the one? Customer concentration issues. We talked about customer acquisition before. So if your customer acquisition is all paid, your traction's all paid, none of it's organic. None of it's based on SEO or referrals or virality. Actually, speaking of which, we have an innovative way that we source startups as a venture capital firm. We think we have an unfair advantage versus other VCs. We think we get an order of magnitude more deal flow than our peers. How do you think we have an unfair advantage when it comes to customer acquisition, i.e. startup deal flow, versus other venture capitalists? Who knows?
Podcast.
The podcast, right? We get in the ears of 34,000 people in every major and minor city in the country, constantly reminding them of our thesis, the way we invest, what we like to see. So we like to say we got eyes and ears on the ground everywhere. All the angel investors, all the VCs, and the entrepreneurs in all these regions. Reno, Nevada, people in Mississippi, people in New Orleans, people in Kansas City, people in St. Louis, where there's not a concentration of capital, where there's not a lot of venture capitalists. So where do you think they send their best companies? They send them to us. So we have created an unfair advantage in our own customer acquisition. You can read through the rest of these, but these are all traction-based reasons why investors are going to pass. So why the objections? Why do you think we spent so much time talking about the reasons why investors say no instead of the reasons why they say yes? Because they mostly say no. That's true. Why else?
Well, I feel like if it was me and I was giving capital out, I'd want to vet all the reasons why I should do this, right? I'd be thinking of why should I not do this deal, and then I'd continue down that path as opposed to why I should. I don't know if that makes sense.
Yeah, that makes a lot of sense. And that's actually related to my point here. The reason we focus on the objections is because you can reverse them, right? Make a list, take all these, make a little checklist in Excel, and see how many you qualify for. Maybe you're not co-located with your founders, but maybe you do have domain expertise. Maybe you do have the builder-seller makeup, right? You can go through all these and see which ones you qualify for, which ones you don't, and some of these are addressable, right? If you just have to get more traction or build a prototype or build an MVP, you can go do that, right? There are some things that you can't change, like your decision-making ability. If somebody's just going to say, I don't think this person has good decision-making ability, that's not really something that you can address. You can just find different investors that share your approach. So be thinking about all these reasons why investors are going to pass, because if you can address some of them, you're going to get a lot more yeses. So how do you overcome the objections? Again, what's changeable on that list that you can improve? Focus plus effort plus communication is investor confidence, right? Anytime I'm working with a founder over a period of time and I just see intense focus, a lot of effort and hustle, and amazing communication, thoughtful answers, responsive, my signal goes way up. My confidence goes way up. Bill Gates and Warren Buffett were being interviewed together, and they were asked the question, what's the single most important factor that's led to your success? In one word, and they both answered simultaneously. Do you know what the answer was? Focus. Focus. Right? Don't do a million things well, do one thing exceptionally well. Focus. Also, ask for advice. It's the age-old saying in capital raising. If you ask for advice, you get money. If you ask for money, you get advice. So go to people. Get their attention. Talk to them about what you're working on. Talk to them about why you're so passionate. Ask for their input. When you ask for their input, all of a sudden you go from being on the other side of the table from them, and it's an adversarial, tension-filled raise scenario, to you're on the same side of the table with them. If you ask them for advice, they're trying to think through problems with you. How do we problem solve this? How do we make this more marketable? How do we think better about the market or the customer opportunity or channel, right? Get them on your side. Get them on your side of the table. Traction is the ultimate equalizer. Traction, traction, traction. If you can go out and drive progress, then capital will follow. And finally, time and interactions with customers. How do they buy? Where do they buy? What do they buy? Why do they buy? This was my ace in the hole. When I was a product manager, I launched a product that was quite successful, a water analytics product. And my ace in the hole was just constantly spending time with customers all around the world. Not only did we build a product that was best in class that customers were ravenous for, but we also understood the channel. We knew exactly how to sell to them, how they would buy, how to create virality. Without going on a tangent to describe that whole situation, the more time you spend with customers, the more dynamic and better your startup's going to be. Steve Blank, who many of you probably know, created the Lean Startup Movement, one of the most famous people in the startup industry in San Francisco, teacher at Stanford. He was on my show and on the podcast, and he said, create a culture of customer obsession. If customers believe, investors will follow. Okay, final thoughts. Final thoughts here. Set clear milestones. Know where you're going with the capital. Know how much capital is required. Remember that 12 to 18 month period. Over the next 12 to 18 months, how much money do you need? What are you going to use it for? Where does it get you? Right? What are the goals with that money? Revenue goals, user goals, expansion goals, right? Whatever those metrics are that you're measuring, keep them focused. 3 to 5 metrics, no more than that. Have defined goals. Know that the capital will get you there. Connect that capital with your milestones. This is a quote by Leo Polovets. He's co-founder and general partner at Sousa Ventures. He recommends, prior to fundraising, ask yourself, why you, why this, why now? If you can answer those questions, you can articulate a pretty compelling story to investors. Why are you the best team in the world to be addressing this problem? If you can't answer that question, or if you don't believe you're the best team in the world to be addressing the problem, you probably shouldn't be working on it. There should be a reason why you're best. Why are you working on this? Why does it make sense for you to be working on this problem? Right? If you've never worked in the beauty space before, why the heck are you trying to disrupt beauty? Right? Or if you've never worked in enterprise IT, why the heck are you trying to sell to large IT departments? Make sure that it connects with you, and then why now? That's the timing question. Why does it make sense now where it didn't make sense 10 years ago, and maybe it won't make sense 10 years from now? All right, who to target? This is the raise matrix. So this was in answer to the question before. What sort of traction do you need at these different phases? All right, so again, this is more of a non-Valley centric matrix that we use internally, but we happily share it with founders. I think we should be focused on this section over here. as opposed to that section over there. If you get this sort of progress, those things can come. It's still a big challenge to get those rounds, and the challenges are different. But initially, it's just how do I raise those first institutional rounds of capital? It starts out with friends, family, and angels. Most people will raise very small rounds just to get going, to get started up, if they don't have their own capital to bootstrap. That moves on to pre-seed. This is where you start getting institutions involved like ourselves, so people that manage money are investing in these pre-seed rounds or early seed rounds. Then there's the institutional seed round, which is right here, seed. That's when you've kind of moved past the prototype and the MVP stage. You're in the proof of concept stage. You can raise more money. You have more traction, bigger round sizes, and larger valuations, right? So we're looking at valuation. We're looking at how much you can raise. We're looking at traction levels and just generically kind of the description of progress, right? Everyone is trying to get to product market fit. That's the golden goose here. That's the goal. Product market fit is when everything is working, customers are talking, you're growing faster than you can handle, things are working, the press is calling. You've got the formula. You know how to acquire customers, and you know that the amount that you're paying, you're going to get multiples back in your lifetime value. CAC, people talk about CAC, customer acquisition costs, versus LTV, lifetime value. That ratio is very attractive when you have product market fit. So this is the elusive thing to get to. This is what we focus on at Newstack a lot with our founders. How do we get to Series A? How do we attain product market fit? Because if we can get our companies to Series A, we're doing really well. And fortunately, we have a good track record doing that so far. The final takeaway here is just target investors that align with your progress, right? Everyone on my team has to fill out this chart for the startups that we're considering, and they have to highlight the boxes, right? So I get a visual. So what happens if this is highlighted, and that's highlighted, and that's highlighted, and this is highlighted, right? Immediately I go, this doesn't make any sense. There's misaligned expectations. People are raising the wrong amounts at the wrong prices. What we want to see is everything in the column is lit up, right? Then we know that the founder has done their homework. They're dialed in to raising the right amount to get the right traction at the right price. So try and fit your stage and your progress level with the types of investors you go after. Are you going after the friends and family people? Are you going after pre-seed VCs, seed VCs, post-seed VCs? Some people call this pre-A or seed plus, Series A VCs, or beyond. Okay, so it's critical that we get the right investor at the right time. Most people will move from bootstrapping, just hustling on their own with their own capital, getting it going, maybe working on it part-time, nights and weekends. They'll do a small friends and family round. They'll raise from angels, and they move on to VCs. And be very careful about raising ahead of progress. Everyone wants to do this. Everyone, they start a company. It's a flashy idea. It's really exciting. Maybe they're doing something super cool in VR at the height of VR, and they go to their friends and family, or they go to angels, and they can raise $2 million at a $10 million valuation. Right out the gate, pre-product. What is the problem with that? Why can that be a recipe for disaster? Who knows?
Expensive for later round.
Expensive? Expensive for the later round. Very good. Other thoughts? Yeah? No sense if the hypothesis is good. Those are the two right answers. That's exactly what I was looking for. You raise a bunch of money in advance of testing the hypothesis, yeah? And you've screwed up the dynamics of the next round, right? If you raise at a $10 million valuation, yeah? And you're back here at hypothesis stage, the next round, how much traction do you need? you need $2 million plus of annual recurring revenue. So in 12-ish months, 12 to 18 months, you better get to $2 million bucks of revenue because you're going to have to raise again. And if you don't get to $2 million bucks of revenue, you're going to become a zombie because you're not going to be able to raise an up round. You have to do what's called a down round or a flat round, and it's a bad signal to the market. Everyone goes, oh, what's going on with them? They screwed things up. So just because you can raise a lot of money at a really high price doesn't mean you should, because that sets you up in 12 to 18 months to be doing this. And if you're back here, it's not good. It's much better to just take smaller amounts of capital, get the right traction at the right time. Okay. Final quote here. Eric Paley, one of the best in the business, top seed investor in the country, based in Boston. Venture capital should be used to scale what works. It amplifies whatever you're doing, good or bad, right? So if your tactics that are in place, if your customer acquisition approach, if what you're spending money on is not really working great, and you throw more money on it, it's going to continue not working great. It's like throwing money on the fire, right? The fire gets bigger, it doesn't go out, it's a problem. Now, if things are really working, if you've got your customer acquisition down, if you know how to expand customers once they come in and make sure that their value is increasing and things are progressing in the right direction, that's what you want to put money on. That's the fire you want to throw money against, right? You don't want to amplify things that aren't working. Because if you do that, you end up in a dumpster fire. Okay, quick Q&A on Module 1, Fundraise Fundamentals, and then we'll move on to materials. Yep.
I just want to better understand why you keep raising every 12 to 18 months. I don't quite grab why if you don't keep raising, then you tune to the zombie hands.
Yeah, so it's, in the venture world, the goal is growth, right? So really, really fast growth. And if you're not growing at a fast clip, then there's this perceived threat that if you're pursuing an interesting category and you're doing something interesting in that category, other entrants are going to come in and get capitalized and they're going to go buy you. Now, that doesn't happen in every case, but if you don't continue to raise and you don't continue to show accretive process, right, not crappy progress, right, like we just talked about on the last slide, good progress, you should be able to warrant an up round, and you're increasing the value of your business, right? So even though like you as a founder, you might go from 75% equity down to 60% equity, let's say, hypothetically, but the value of your equity went way up because you're raising at a much increased valuation. So even though your raw percentage of equity goes down, your value as an individual founder goes way up by continuing to raise these up rounds. So it should be accretive to all involved. You shouldn't just be raising capital to give away part of your company. You should be raising capital to increase your ownership as well as the value of the company and expand the, what did we talk about before? Defensibility? Your moat. Expand the moat, right? If you raise capital and you continue progress, you can make that moat broader and deeper, which prevents other competitors from coming in and copying what you're doing. Other questions on the fundamentals? Yep.
Why is there an aversion to NDAs?
Because we see so many pitches. I mean, there are many days where we're seeing 10 pitches a day, that there's so much overlap in the pitches that, you know, we don't remember what we learned from one pitch to the next. I wouldn't remember that, you know, I'm sharing info from one to another. And so all VCs will never sign an NDA, all professional VCs. Some angels will and some non-professionals will, but no professional VC will sign an NDA because the risk is just so high because you're getting so many pitches constantly, you don't remember where you've acquired certain knowledge. And if somebody tries to sue you saying, hey, I had that in a pitch deck that I sent you 2 years ago and now your company's doing it.
You may have inadvertently say something that you didn't intend to write it.
Or maybe you don't say anything. Maybe somebody sent you the pitch deck and you hit delete, but then 2 years later, one of your portfolio companies is doing something that was in that pitch deck, and then that founder accuses you of stealing it. And you go, I don't even remember seeing your deck. So there are no NDAs being signed because there's just way too much deal flow going around. And to be honest with you, investors and VCs aren't trying to steal ideas. It's really about the founding team, driving their own mission, their own strategy, working with customers to further develop that strategy. Yep. Up front.
Just a clarification on the timing of the raise. I think you mentioned it should be 3 to 6 months before the end of the runway. Is that what that 3 to 6 months?
Yeah,
intend to raise?
I said 3 to 6 months for this presentation. So if you're planning on raising, in the next 3-ish months plus, then this is a good place to be. If you're planning on raising in the next couple weeks, it's not. In terms of when you should be planning your raising, my default answer is to always be raising. So always be talking with venture capitalists, always be building relationships. Another way to put that, actually, I'm planning to write a blog post about this, but I was going to call the blog post "Never Be Raising." Because you know what my C founders do? We don't really have C founders in our portfolio, but the C founder, grade C on his report card or her report card, is very opportunistic, very random, right? Never planning things out, just kind of, oh, you got a connection here or there, very sort of haphazard in the way they raise. But they somehow pull it off because at least they take the meetings, right? The B founder, the one that gets a B on their report card, is the founder that's very strategic, very intentional, building the pitch deck, making it awesome, working with investors, planning the raise amount, planning the schedule, launching the raise process, building their funnel, and just going after it and drilling it, right? Those are the B founders. You know what the A founders do? That's good. Let people come to them. Yeah, in a way, they're letting people come to them. So the A founders, they're never raising capital, right? If you ask them, oh yeah, I'm not raising. I'm just building relationships, right? They're just going around and meeting everybody. Oh yeah, we'll probably raise next year, but we're just looking. We happen to be in San Francisco for the week, so we just want to meet with you, right? People do that all the time. The really savvy founders, hey, I'm going to be in Chicago next week. You mind if I grab some time? Are you raising? No, we're not raising, but we're just working on some interesting stuff. Yeah, I want to take that meeting, right? So the real savvy ones, they're never really officially raising. Now be careful with that. If you're not like a savvy salesperson and stuff, don't get cute, right? If you have to drill a fundraise, you can be intentional about it and you can get it done, and a lot of good founders do it. But the real sort of expert level, they're very smart about it, and they build all these relationships, and then what happens? To this gentleman's point in the back, the investors come to them and they try and preempt the round. That's what we call it in the industry. So before they actually go and officially fundraise, the investor meets, with their internal group, and they say, we better give these guys an offer because they're going to get an offer from somebody. They're great. And so they preempt the next round, give them an offer, usually at a higher price than maybe they've earned from a traction standpoint, so that investor gets the pole position. All right. Any more questions? Good. Okay. Module 2, the materials. Draft the deck and the supporting docs. All right. In this module, we're going to cover the types of materials that need to be created, the structures for the fundraise itself, the options that are available, and finally, the key elements of the deck. We're not going to go super deep on the deck because we could probably spend an 8-hour course just going through the deck. So I'm going to highlight kind of some key points on the deck, but we're not going to go super deep. All right, what materials do I need? All right, you need 2 versions of the pitch deck. Not 1, 2. All right, you need a long deck, which is about 10 slides, and you need what I call the teaser deck, which is 5. You need a pro forma, all right? So make sure you have financials, a P&L, cash flows, before you meet with investors. Subsequent to your meeting with investors, as you get a round raised, you're going to have to put together more materials. An investor might ask you for a data room. They might ask you for a lot more docs. That's all fine. This is just what you need before you start the raise process. Have this stuff ready and together, and then when investors ask you for it, boom, you're on it, right? Within minutes, you've sent them the pro forma. Investor asks, hey, do you have a pro forma? Boom, here it is. Oh, not like, oh, well, I'm going on vacation. I might send it. Can I send it to you in like next week, late next week sometime? No. Have it ready. Pro forma. Cap table, right? This is just a record of your ownership. Most people do this in Excel to start. That's fine. You can start out in Excel. You get bonus points if you do it in Carta. Carta used to be called eShares. We've had them on the show. They're a sponsor. It's a great company. It's basically cap table management in the cloud. You know what happens when you have Excel documents, you start sending them around, like one says one thing, another Excel document says another, people are updating the wrong one. So as you start to get investors, lots of investors, it gets really messy in Excel. So Carta is sort of that online cloud place where everyone's equity is up to date. And Carta does other things too. Incorporation docs, so make sure you have those. Hopefully you're a C Corp. If you're an LLC, have a plan to convert to a C Corp if you get funding. You don't have to convert in advance. You can make that conversion contingent on the funding round. But have your company records, bonus points if you're a C Corp in Delaware. And then finally, your offering docs. This is what we're going to go into first. So safes, convertibles, and equity rounds. So which structure do I use? Who's heard of safes? Lots of people. Okay. Who's heard of convertible notes? All right, lots of people. So you guys have clearly thought about how the heck do I choose which structure, right? It's not easy. It's like, what are these different things? So first, SAFE stands for Simple Agreement for Future Equity. Y Combinator, the famous accelerator in San Francisco, came up with this document. This was a way to kind of simplify the whole process of early stage investors making investments, angels and early stage VCs. We had started out with equity rounds, which are quite complicated, quite long, very long agreements, lots of legal fees. Then we migrated to what's called the convertible note, which many of you are aware of. The convertible note was originally a bridge instrument to get you like a couple months in between rounds. So if you were negotiating, but you're running out of money, you could do these little bridges, get some money in to kind of get you to the next round. And then people repurpose the convertible as just an instrument for investment. But there are all these kind of issues and unintended consequences with that. And so hence the SAFE came about to replace the convertible. So it's sort of the modern version of the convertible. It is probably the most common instrument used now, certainly in San Francisco, at the early seed phases, okay? Nationwide, it's still probably the convertible. Safes are most popular in the most modern regions, then convertibles after that, and then equity rounds for those initial rounds. So let's talk a little bit about the SAFE. It's considered the most founder-friendly of the three. It's also very simple docs. You know, SAFEs can be a couple of pages. They don't have to be super complicated. It's just an agreement that will convert into equity in a future equity round. So if you end up going and doing a big Series A from a big-time investor, then your SAFE will turn into equity at that point. You're going to use something called a valuation cap with a SAFE. So a valuation cap is a proxy for valuation. All right, so if you're doing a traditional equity round, the most important term that every investor is going to want to negotiate with you is your what? Valuation. Bingo. The most important term that any investor is going to try and negotiate with you is your valuation. In the case of a SAFE or a convertible, there is no valuation, but there's something called the valuation cap, which is not a pure proxy for valuation, but it's pretty darn close. So negotiate that one carefully. There's also a discount rate, so you have to be aware of the difference between discounts and caps. There's typically no interest on a SAFE. It is not a debt interest-bearing instrument, which is one of the primary differences with the convertible. That convertible note I mentioned before, that is actually a debt-based interest-bearing instrument, which creates kind of some issues. This is not. So that can be better for founders. One of the biggest advantages to safes is you can raise on a rolling basis. Who knows what that means? Any thoughts? Yeah, up front.
You have to close on the round.
Perfect. Awesome. You don't have to have a close on the round, which can be a major advantage. Not in all cases, but if you're doing a priced round, i.e. you're selling equity, doing a formal equity round, you need to get all your investors to close and wire you the capital on the same day. So they all have to sign the docs, they all have to come to an agreement, and you got to get that whole herd of people all ready to go on the same day. It's not easy, right? If you only have 2 investors, no problem. But if you have like 10 investors and you're trying to convince people over time, it can be tricky, right? You convince this person, this woman on, week 1, and then you convince this guy on week 8. Hopefully the week 1 investor is still ready to go. Especially with angels, right? Because angels don't have committed capital under management. VCs have committed capital under management. So if they give you a commitment, they're good for it. Angels, sometimes it's just coming out of their basket of their bank account. And if something happens, they get divorced or, the stock market crashes or anything, all of a sudden that money goes away. So getting everyone to close on the same date's tricky. There's limited investor recourse in bear cases. So in some of these other cases, investors can kind of stick it to you in tricky scenarios. And know that some angels have a strong aversion to safes and convertibles, especially inexperienced angels. So people that aren't in major areas like San Francisco, Chicago, Boston, Austin. If you'll find angels in other areas that are just, I won't do any safes, I won't do any convertibles, they will only do equity rounds. All right, the convertible note, very similar to the safe. The primary difference that you should be aware of is there is an interest rate. So what that means is if I invest $100,000 in you, I'm actually investing more than that, right? Let's say the interest rate is 10%. If you raise 12 months after, what's the true value of my investment? I invested $100,000. $110,000, right? So even though I invested $100,000, I actually end up getting equity for $110,000 because there was a 10% interest on the note. Now that's also tricky for investors because investors don't really like the interest rate. Even though they're getting more equity, guess what they have to pay on that interest? Taxes. Immediately. Not in the event of success, right? Most of this stuff is like only in the event of success do we, pay out on these things. In this case, you got to pay taxes on the interest, which is not good. Also, you can get in tricky situations with convertibles because if you don't convert it in that 18 months, usually they're 18-month terms, you can extend them. But if you don't convert the note in that 18 months, investors can ask for their money back with interest. It can get dicey. I don't see that happening very often, but I heard of kind of a really big name investor in San Francisco doing it on a recent deal, not one of ours, and it really screwed things up. So that can be a little tricky. So make sure you hit that 12 to 18 months, if you're doing convertibles. And finally, we got the equity round, the price round. So this is the most standard original agreement. This is how everything started, right? You're buying equity just in the private market in the startup. So the challenge with this is the docs are longer. They're more complicated, which they're not really that complicated these days. I mean, these things are fairly standard. You can go to a website called seriesseed.com and you can download standard seed docs. But they are longer. So you need to retain an attorney for any of these, and your attorney fees are going to be higher for a price round than they are for others. You can't do the rolling close, right? You have to get everyone to close on the same date, so that can be tricky. And then the tax, so the biggest investor benefit, the reason why people like us prefer these, and in most deals I do this, is why? Does anyone know? It's because the tax clock begins. I know it's hard to see up here. but it's a tax advantage to do these equity rounds. There are capital gains taxes that are assessed, and capital gains taxes that are assessed on private equity investments are based on your hold period. So the longer you hold equity as an investor, the more likely it is you can avoid high capital gains. And so we always want to get our equity as early as we possibly can, because that starts the capital gains clock for us and helps us limit taxes. The trickiest thing that you guys should know with the safes and the convertibles is because there's that rolling close dynamic that we talked about, you can kind of take money in as soon as you get a commitment. You could be sitting with an angel. The angel investor could say, I'm in for 50K. You can pass them the docs. They can sign the docs, and you can give them the wire info, and they can wire the money. Or they can give you a check. It's that simple, and therein lies a problem. It can be a little too easy to raise on these safes and convertibles. So some founders get themselves into trouble. They'll raise one little round on a convertible, they'll do some more. Instead of being really focused and disciplined and saying, here's our 18-month ramp, here's who we're hiring, here's how we're spending the money, they get a little too likely to raise more money, and before they know it, they've raised too much and given away too much equity, and it becomes a problem at Series A. I don't want to go too deep on that, but the lack of discipline with the first two can create some issues because they are very flexible, right? Like you could close a round, you could close a formal pre-seed round, it's done, and then a month later an investor comes in and goes, oh, I wanted to get in so bad. How about I just give you, $500,000? We'll raise the price. I'll just do it on a convertible. And you as the founder, you say, well, okay, I'll take another $500,000 at a higher price. But before you know it, you've taken so much money, you've ended up selling more of the company than you expected. So you really got to watch your cap table with these first two. Okay. What's best? All right, so early on, the safe and the convertible is the cheapest and the easiest. So if you're a very, very early stage company, it's probably common that you're going to raise from friends and family, or you're going to raise from angels on a safe or a convertible. If you're doing a very small raise amount, it's very common you'll raise on a safe or a convertible, because the legal fees can be, call it 5 to 10K, maybe 15K in an early round. Do you really want to spend that amount, from the fundraise? Probably not. So you're going to want to limit those legal fees in a small raise. If you can't secure a lead investor, is anybody familiar with the term lead investor? Okay, what does lead investor mean?
Like the guy who takes the lead in rallying the rest of the investors behind them, negotiating everything on their behalf.
Perfect. So the lead investor negotiates the terms with the founder, sets the terms, creates all the structure, and then rallies the rest of the syndication partners, the other VCs, the other angels, all together. So the lead has a very important role as an investor in the deal. In some cases, in a very early stage startup, you might not be able to find a lead investor to price it and structure it and find all these other investors. So you might just raise ad hoc from angels and investors as you can. You might just come up with a convertible note and put a fair price on it and just start taking capital instead of securing that lead. So if you can't get a lead, it's better to do a safer convertible. If you do have a lead, they're probably going to want to do a price round, an equity round. If there's a really low amount of capital required to get to a huge milestone, right? Let's say you're just a month away or 2 months away from this huge watershed moment, right? Iteration 2 of the product, you're going to launch it, it's going to go viral, things are going to happen, right? But you need an infusion of capital. You need $30,000, $40,000. In some cases, it can make a ton of sense to do a small little round, a small little capital infusion on a convertible or a safe just to get to that milestone. Because as soon as you get to that milestone, assuming things go well, what happens to your valuation? It goes way up, right? If it's a major product milestone or a major revenue milestone, if you've made material progress on the business and advanced the business forward, then you're going to be able to warrant a much higher fundraise amount at a much higher valuation. So that can make sense. remember, lead VC investors will likely prefer the equity round. We talked about that. And then in cases where the investor is trying to optimize for tax implications, we covered that, equity is best. Then the safe, convertible after that. So this kind of gives you a little roadmap of what the preferred method is. Obviously, if you end up getting interest from a very strategic value add VC and the VC is hard up on the equity round, maybe you meet them there. If you're really hard up on doing a convertible or a safe, just talk to your investor about it and give them the reasons why you want to do it. You know, if you're doing a really small round, you can tell them, you know, it's a really small raise, trying to avoid some legal expenses, for instance, and most investors will be amenable. The deck. All right. Let's go through this quickly. So the goals of the deck, you need to use decks as a tool, not a crutch. Think of it as a sales tool. Don't lean on the deck too heavily. You want to use it to drive interest and intrigue. Leave investors hungry for more. Every time I see a deck that's just crowded with text, tons of information in it, I immediately shut off. I don't know what to read. I don't know what's going on. It's just very confusing, right? Think of it like a 5th grade audience. Huge ideas, very clear, very simple. Your investor is most often not your customer, right? Your investor is not the target market. So they don't quite understand your market the same way that you do, particularly angels, right? If you talk to some angel investor that's got great experience in industrial automation and you're doing a consumer brand startup, they're just going to have a tough time getting their head around it unless you break it down very simple and clearly. Engagement is the key. You're trying to create a dialogue. You're trying to create that back and forth, whether it's over email, whether it's in-person coffee meetings, whether it's phone calls. You want the tit for tat. You don't want to give away everything on the first date. If you have a meeting with an investor, and we're going to get into this more in a different module, but if you have a meeting with an investor, you want the investor leaving that meeting saying, I want more. When can you meet next? Right? Because you haven't given them everything yet. You haven't gotten into everything. So create intrigue, create that back and forth, create a dialogue. Narrative that a 5th grader understands, we talked about that. And finally, the don'ts here are the walk-through read. So that is, you know, you meet with an investor and you have the deck either on your computer or print it out, and you go through page by page, you know, reading everything. It's not what you want to do. When you're meeting with investors, you want to be storytelling. You want to be engaging with that investor. You want to be asking them questions about what do they invest in? What is their check size? What really gets them excited? You know, what sort of deals have they done in the past? What founders have they worked with? Also, don't try and close with a deck. You know, I get these emails from founders all the time, like, here's the deck. Are you ready to invest? You know, how much do you think? It's like, no. The deck is not it's a tool for getting a meeting. It's not a tool to close. And don't answer all the questions in the deck. Here again, create that intrigue. This is my quote. The deck is a place where investor conversations go to die. Less is more, keep it simple, clear, light on detail. Okay? If you have too much in the deck and you send it, investors will find something that they disagree with. They will find something that they dispute. They'll find something that gives them a reason to pass. Remember all those past reasons we went through before? All those? You don't want to answer all those questions in the deck. The deck should just be intriguing enough to get the meeting. Because once you get the meeting, you should be able to get the investor excited, right? And then they'll kind of overlook a bunch of those things. But if you answer every question in the deck straight away, they're going to find a bunch of reasons just to quickly get to know. Less is more. All right, slides in the full deck. First, you know, you need a header slide. Company name and tagline. Company name, tagline. Keep that tagline really tight, really clear, right? Disrupting supply chain management for large and small companies in the automotive space. Not good, right? Not good at all. Enterprise supply chain optimization. Boom. Keep it clean and simple. Tighten up that tagline. Make it really focused. First, slide number 1. we need to talk about exogenous factors, right? We need to talk about market factors, external drivers. So these could be market-driven, they could be regulatory-driven, they could be customer. What's going on in the market space that has created problems or created opportunities? Don't start this first slide with, here's who we are and here's what we're doing, right? This first slide needs to be, what's going on in the space? What's really interesting? We just invested in a space tech company that's doing aerial imagery, right? So they have a balloon-based system that goes up into the air and takes pictures, right? The exogenous event here, or the external driver, is that the value of aerial-based data is through the roof now, and the number of customers that want aerial-based data has exploded. It's a huge new market. You know, it's not just insurance companies and weather companies anymore, it's tech companies, it's Google Maps and Waze, it's you know, all these different potential buyers of aerial-based data that want to monitor urban areas are interested. So, exogenous factors. Start out with that, then move on to your problem statement. How's it done today? No solution exists to address whatever you're going after. And quantify it. Put a metric in there. Metrics win in pitch decks. Use metrics on every slide if you can. Solution. How will it be done tomorrow? It's that simple. Here's how it's done today. This is why it's broken. Here's how it's done with us. You know, what are you building? What is it solving for whom? Make sure you identify the customer in your solution slide. Number 4 is your first reason to believe slide. So this is substantiating why you guys are great and why you're the right people to be addressing this. This answers the question, how does it work? Right? Because you should be creating this intrigue in the deck. Every investor should be saying at this point, how is this possible that they're doing this? Well, we have this technology behind it. We have the foremost artificial intelligence machine learning expert, right, that's designed new aerial imagery analysis, for example. You need to answer the question, how does the tech work? What's the magic? And what's the tech behind the product? Number 5 is the business model and economics. How do you make money? Talked about that. Number 6, we talked about the market a couple times today. 3 slices of the market, typically concentric circles. SOM is small, SAM is bigger, TAM is bigger than that. Here again, on a time basis, SOM is usually your target market for the first year. Your SAM becomes the target market for like year 3-ish, and your TAM is the target market for year, who remembers? 5. Lots of you. Good. SOM, SAM, and TAM. Your go-to-market strategy, right? How are you going to acquire customers? What channels? What tactics are you using? Number 8 is the second reason to believe slide. So this substantiates why you're the best to be going after this, why it makes sense. Traction, right? Metrics, metrics, metrics. Throw as many impactful metrics up there as you have. Impactful, right? Usually that's like 3 to 5, in some cases 6. But if your customer acquisition cost is exceptional, if your lifetime value is off the charts, if your NPS score, Net Promoter Score, is really high, if your revenue is great, if your growth rate is great, highlight the metrics that are just going to jump off the page and make investors go, whoa. Number 9 is the third reason to believe slide. This is the team, right? There is a team here that has the appropriate level of expertise and experience to be going after this. This team makes sense to be working on this problem. Slide number 10, the ask, right? How much you raising? What are the details? What's your runway? 12 to 18 months, hopefully closer to 18 months. If your runway is 6 months, quick pass from us. It means you haven't really thought this through and you haven't done your homework. And your milestones. Remember, connect the capital to the milestones. What does this raise get you? If you're at 500,000 in revenue run rate right now, does this get you to 2 million? If your CAC is X, does it help you lower your CAC somehow? Your customer acquisition costs? All right, this is the key deck though. This is what I call the teaser deck, which is 5 slides. This is what we use at NewStack as bait. It's no big secret that our follow-on rate is very high. We've been able to help our startups secure follow-on funding from larger investors at later rounds, Series A and beyond, because our startups are awesome and our founders are awesome, but also because we work hard at capital strategy and fundraising. And we create this teaser deck, which is just 5 slides. Very tight, very focused, lots of intrigue, right? You're just highlighting the key, sexy, exciting things, right? What's the factor that's disrupting everything? What's the market-based external driver that's creating massive opportunity? What are you building? How big is the market? What's your traction? And who are the people behind it? You hit them with this teaser deck, they're going to have a ton of questions, especially if it's good. They're going to be saying, shoot, I need to get on a call now. Right? If this teaser deck is done well, you can get a lot of meetings with it over email. Remember, the deck is a tool. Don't use it as a crutch to flip through at a meeting. Oh, I'm going to go through every slide. The meeting is for storytelling. Right? The deck is bait. All right, expert tips. Keep it clean, light on info. The goal is to create intrigue. The deck is the currency of fundraising. Use it to get meetings, not during meetings. Tool, not a crutch. You can also use it as a follow-up tool, a reference tool. So here's an advantage to that teaser deck. What do you have waiting behind? The full deck, right? So if you use the teaser to get the meeting and you need some follow-up stuff, you can always, hey, I'll send you the full deck if you want to review it. Keep that conversation going, keep those touch points going, keep a dialogue going. Advisors aren't necessary. I see all these decks where people are 3 slides full of advisors. We don't know who any of these advisors are, honestly. Like, they may be great, like perfect for you in your industry, so helpful, but we don't know who they are, so leave them out. Lose the competitive matrices, these X, Y dimensions. Oh, here we are, these tables like checkbox. Oh, we do all these things. These guys only do these. If you're doing something really interesting and something really compelling, you are competing on a different dimension than everyone else, right? X and Y axis out, you're on the Z axis. You're doing something totally different that nobody else is seeing. You've had an epiphany about the market because you spent so much time with customers that nobody else has had this epiphany. Huge opportunity. So you're just competing in a completely different way than everyone else. And finally, highlight that moat, right? Why is what you're doing super interesting, super defensible, and other people just can't do the same thing? All right, we'll finish up here with the funnel and target list of investors. We got started a little late, so is Furman in here? Can I ask? Yeah, can you grab them? See if we can go over 10 to 15. If you need to leave, of course, you're welcome to. Any quick questions on the materials before we move on? Yep.
Where do you put the moat, and which slide do you put it in?
I would keep it more as a talking point and more as a follow-up. So the deck itself, you don't have to highlight the moat. If there are ways that you can allude to it in the solution you're building, great. Sometimes the moat is the team itself, execution-based. Sometimes it's network effects, which can be implicit or explicit. But certainly in your storytelling and the way you articulate it, you should be able to show why this is really interesting and defensible and other people can't do it.
How do you present the Z-axis that you were talking about, and how do you link that with that?
Yeah, so that should come out. So here again, don't use the competition slide. Good? Okay. The Z-axis and why you're truly different and doing something interesting that nobody's thought of should come out here, right? Remember, it's no solution exists today that's doing this. we're doing this. All these other people are doing this over here. We're doing this. And it should be a dialogue point too. Like a smart investor is going to ask you, I know of competitor A, B, and C. How are they not just going to do this? How are they not going to copy you? Or how are you different? And you can very clearly and succinctly say, oh, well, this guy's doing this gal is doing that, we're over here doing this, nobody sees this opportunity, or nobody cares enough about it. Other questions? Yep.
What do you think about presenting a SWOT analysis? Strengths, weaknesses, opportunities, and threats.
It can be an interesting talking point. I wouldn't put it in the deck. Other questions? All right, let's move on. All right. The funnel, building your target list of investors. All right, so we're getting on to the fun stuff. I'm going to try not to jump into this. This is for, session 2, 4, 5, and 6. But I might dabble a little bit in how to present. I'll try and stay away from it, though. This is more about how do you build the list that you go after, right? How do you do that business development to know who those investors are that you're going to drill, you're going to reach out to, you're going to get meetings with? This element, the presentation, is really about securing those meetings. So how do you get the meetings? How do you reach out to investors? That's 4. All right, build an investor funnel. This is how most founders do it. Most founders are very opportunistic. We talked about this before. They're not strategic. They're kind of willy-nilly taking meetings with people and saying, like, do you know anybody? Or how do I do this? Or very sort of haphazard. There's no prioritization, right? So many founders, I see them doing this, they're kind of just meeting with investors whenever they can. They're not thinking about who should I be meeting with first? Who should I go after next? And prioritizing that list. A lot of founders treat this whole thing as transactional, right? I'm going to meet with you. I'm going to convince you that my story is really compelling. I'm going to get your money. And that's the end. They're thinking of it as a transaction. It's not a transaction. It's a relationship. It's a very, very high-touch, long-term relationship. The relationship with your investor outlasts the average marriage, which is a little scary, but it's something to be aware of. You're going to be working with these people very closely for a long time. So do not treat this as transactional. Treat this as true relationship building. A lot of people don't make the raise the priority, which I can understand and I can relate with. You're working on building a business. You're passionate about that business. You're meeting with customers all the time. And then you go out and kind of try and raise capital and you do it half-assed. Yeah, not the way to do it. This is often evident in communication. The communication and the meetings and everything becomes unmanageable. It's really hard to get back to investors, and follow-ups really aren't there. So you got to think really hard about doing a capital raise first. And then when you do it, make it the priority. It's got to be number 1. So if you have a co-founder, the co-founder kind of has to pick up the slack on the business side while you're raising that first round of capital. Because if you're dragging your feet with investors and you're not on your game, they're going to lose interest. The next thing is all cold, right? So a lot of founders do this. They just reach out cold via email to investors. Now, there's nothing wrong with that. I'm a huge fan of reaching out cold. That's how I started in this business, right? I started this podcast where I couldn't get a meeting with Howard Tolman or J.B. Pritzker, right? They didn't know who I was. I was just some independent angel that had some success at a company. They had no interest in talking to me. Showed up with a microphone, found an interesting angle, an interesting pitch, got their attention. All of a sudden, I started building a network, right? So I'm not averse to cold. And we've actually done, I think, five-ish deals from cold outreach, meaning a founder just reached out to us over email, and you can be sure they had something really nice and interesting to say. They probably listened to the show. They talked about an episode. They talked about why they really like NewStack. here are portfolio companies that like really make sense with what we're doing. So it's a very thoughtful email, but don't be all cold, right? Don't reach out to everybody cold. Try and work the network and get some referrals, get some introductions. And finally, targeting the wrong investors. This happens all the time. I see founders, meeting with Series A investors or meeting with people that are way too far along for what they're doing. Remember that fundraise matrix that we presented before. Make sure that you're meeting with the right types of investors for your stage, because a lot of investors will just meet with you because they want to see what's going on and what's interesting, but it's just a waste of your time and it's kind of a waste of theirs. All right, your investor funnel. First step is to create your startup profile. We'll talk about that. Second step is who to target and where to find them. And the third step is to build and manage that list. So creating the startup profile. So the profile worksheet, this starts with self-reflection. Okay? You're going to have to do kind of an internal evaluation of who you are as a person and who your startup is. I recommend that every founder starts with this. Simple worksheet, right? What stage are you at? Use the fundraise matrix. What geography are you in? Write it down. Write down your city. And what sectors, categories, or tech themes are you exploiting? I'll give you a sense for this. Oh, that's not going to work. We'll get access to that. But there are a variety of different categories that apply to what you're doing. Maybe you're a B2B company. Maybe you're SaaS. Maybe you're doing something in automation. Maybe you're launching a product into automotive. Maybe you're doing something with AR, right? There's all these different categories that sync up really well with the way investors identify themselves, right? Investors identify themselves around all these categories and themes, choose to invest around those themes, and so you need to link up with the investors that like the categories that match your startup. So you will get access to that list. Go through the list and check all the ones that apply to what you're building. And then those are the categories or the hashtags, as I call them, that you want to use. Finally, at a personal level, think about your team. Think about the schools you've attended, the businesses you've worked for. Maybe you have a faith. Maybe there's certain demographics that apply to you. There are skills, disciplines, and functional roles. So maybe you've been an expert in direct marketing. If you can find an investor that shares that commonality, that's good. Industry expertise. If you've got aerospace experience and you find an angel investor that was an aerospace executive, they're probably going to love talking to you. Notable interests, hobbies, and sports. Think about things that really make you who you are, what you're interested in, make you unique, and also apply to other people. Not so unique that it won't apply to anybody else, right? If you've got the Guinness Book of World Records in hot dog eating or something, you're probably not going to find an angel that's done that. But if you've done something unique that applies to other people, then that can be a point of commonality, and that's what you're looking for in investors. All right, we're going to skip the brainstorm session, but I want you guys all to do this after the session. So write down your own hashtags. Go through that list. The PowerPoint will be available. And think about all those categorical things that apply to you specifically that may apply to investors as well. Maybe a good reason to meet. I just had a founder get a meeting with Vic Pascucci at Lightbank. He's the MD over at Lightbank. You know how he got the meeting? He saw Vic in a video talk about training Barack Obama in Taekwondo. Okay? So they were both at the same dojo. And this founder was a black belt in Taekwondo. And he reached out to Vic and was like, hey, we got this crazy random, similarity. And Vic took the meeting. And that doesn't mean Vic is going to invest, but just getting in the door is major. All right, who to target, funding sources. You can bootstrap it. You can get grants, friends and family, individual angels, angel groups, syndicates, accelerators, venture capital funds, banks. There are venture banks. They typically don't fund really early. You have to get some traction and get some investment from VCs first. There are limited partners. These are the folks that invest in VC funds. Sometimes they also invest direct in startups. There are corporate VCs, studios and foundries. Anybody know what a studio is? A venture capital studio. So a studio is a VC, but they usually wear one of the major hats for a founder. So let's say you're a founder with great domain expertise in retail, right? And you're building a startup in retail, but you have no development experience. You don't know how to code. You don't have a co-founder. You can't find a co-founder that knows how to develop, and you need to develop some tech. You can go to a studio, and a studio will be your development co-founder. They're going to take a ton of equity. They're probably going to take half, maybe not quite that much, but they will be your counterpart. They will be your co-founder and do the development. Different studios have different expertise. So there are some studios that are commercial experts. So maybe you're the coder, you're the developer, but you need somebody that knows how to market or somebody that knows how to sell, right? And they have whole teams of people that are just designed to help. Exited founders, think about other founders that have exited that have some money that may want to be angels. And the best funding source, customers, right? So go out and sell your product to customers. Self-fund as much as you can. Where to find investors, events, networking, incubators, the Angel Capital Association, GUST, National Venture Capital Association. You can also go to Crunchbase, as well as, these bullets are a little off, but there are accredited equity crowdfunding platforms like AngelList, if you've heard of that. There are a bunch of them. These are all places you can go to source investors. F6S is an accelerator listing system. So if you're looking for accelerators, you can go there. Preqin, CB Insights, PitchBook. These are all databases that have many investors. University Investor Networks. You can go to the local media. So in Chicago, that's like Inno and Built-in, Blue Sky, Technori. Hopefully you've heard of some of these at this point. These places have lists of investors, VCs, angels. You can look at the local VC and angel bloggers, podcasters, and when in doubt, do a Google search, right? So if you're looking for founders that are doing something in retail, that D2C, direct to consumer, in Chicago, maybe you can find angels by doing a search there. Finally, build and manage the list. I'm not going to go through all these things, but either identify a CRM, use a CRM like a Salesforce tool. We use Streak, which is great. But find a CRM or just use a spreadsheet. You can use Google Sheets, Excel, Airtable. But start tracking all these contacts, right? Here are the column headings that I use and I suggest founders use. You want to know who you're reaching out to, when you've reached out, when you need to reach out next, their contact info. This key one here is notable info. If you learn stuff about people, interesting stuff that they're really passionate about, write it down. I just met with an LP, so an investor in our venture fund out in Colorado, who's super passionate about something called Defy Ventures, which is going to prisons and working to help prisoners develop startup ideas. He's really passionate about that, right? I wrote that down because I take so many meetings, meet with so many people, I'm going to forget this stuff. But you know what I'm going to mention the next time I meet with them? How are things at Defy? Did you go in September like you said you were going to go? Did you meet with Raymond? How is Raymond doing? How's his startup progressing? Right? Write this stuff down and ask these people. Humanize this experience. It is a relationship. And then finally, tips on how to prioritize. Think about who's best to raise from, and don't start with all your A targets. You're going to have priorities, 1, 2, and 3, and you're going to have ranks A, B, and C. If you have an A investor you're going after that's like the perfect fit, that is ideal for exactly what you're doing, do you want to meet with them first? No. No. You need to practice the pitch. You need to hone the skills, right? You need to tighten things up. So practice on your network, your close advisors, your friends, people you've known for many years. It's really easy to start with that first group of 20. Make a list of these people you've known for 10 plus years that you've built relationships with that are experienced in business. They don't even have to be angels. just reach out to them. Say, hey, I'm working on a new project. I would love some advice. I think your experience here could be really useful. Will you take a meeting? Those first 20 meetings, just with people that you've built relationships with. And before you know it, they'll start networking you around. If you ask, do you know any angels? Do you know any people that specialize in this? They're going to start making those referrals. Okay. Friends and family first, angels second. Angel groups take a long time and they prefer tons of traction. So they're more Series A investors these days than they are early seed. Ask for advice. Manage your stages. These are the stages I use when I'm closing investors. Have I contacted them? Have I gotten a meeting? Are they interested? Have they passed? Are we in negotiation? Do I have a verbal? Do I have a signature? Do I have capital? And just some suggestions, on how to handle these meetings, how to handle this engagement. And finally, this is the last slide. This is bonus points if you do this. Think about entrepreneurs at funded startups in similar categories or similar hashtags to you. Maybe you went to what's an obscure school? Maybe you went to Ohio Wesleyan, for instance, right? And there happens to be this well-funded founder in Chicago that went to Ohio Wesleyan. They're working on something completely different than what you're doing, right? But they went to the same school. It's very easy to reach out to that founder and say, hey, I'd love to meet with you, pick your brain on fundraising and startup building. And because you have that commonality, if you mention it, they might take the meeting with you, right? But it's even more important that you meet with founders that are kind of in your space. So if they're not doing exactly what you're doing, but they're in a similar domain, then that means their investors like that space, right? So if the entrepreneur likes you and you build a relationship, not only can that entrepreneur help you with KPIs and how to build, how to acquire talent, how to see around corners, how to think through things, because they're a few steps ahead of you. But if they really like you, they'll say, yeah, I'll make some introductions to our angels or our VCs. They'd be happy to meet you. So that's the final thought today. I'll take 2 quick questions and then we got to wrap. Any questions on building the investor funnel? I know we went through it fast. Yep.
You didn't really talk about the manufacturer as a potential kind of source of capital. Is that not something you see so often? I heard in GoPro's story that they had amazing terms with their manufacturer and that essentially allowed them to forego kind of some of the funding between rounds or even skip full rounds.
Yeah, I would say that's the exception. It's not the rule. It does happen. So if you have a hardware startup and you're working with a certain manufacturer that has an appetite for this sort of thing, you can always get these serendipitous, like customer. Maybe you have a customer that says, hey, I would love to invest. Or you have a supplier that says, hey, I would love to invest. And you got to kind of keep your ears open for that. But that's an anomaly. It doesn't happen super often. Any other questions?
How many, so talking about the funnel, right? So once you do get to your A investors,
Yep.
rough rule of thumb, how many conversations or relationships should you be actively seeking to build to increase your probability of a close?
Well, we have David Ravi from Tavalla in the room. Everyone give David a hand. David has closed a Series A. He's closed a growth round after the Series A. He's leading one of the most dynamic and exciting startups in Chicago. He's probably better to answer that than me.
I have PTSD when you ask that question. I mean, we've probably talked to hundreds, maybe close to 1,000 investors over the last 4 years. Like, it never stops. And you need one. It's just like marriage. Like, you need one investor to come in and lead you around, and then the domino falls and lots of other people follow suit. But it could take 200 conversations to find that one that's willing to take a leap and go against the grain. So it's more than you think. That's probably the short answer.
So what percentage of time are you actively doing this?
We were in on that round too.
What was, do you mind sharing what was the accelerator? That you
Y Combinator.
Y Combinator.
What type of industry you're in?
We're in the, it's complicated, we're in the smart kitchen industry, so smart IoT, and then also food delivery. So kind of two very different industries that come together.
So there is no regulatory framework, no high bar.
No, no.
How did the team come together? I don't think I've heard that story. So like, why was the human capital willing to kind of get along?
So, yeah, long story. The short version is we won a business plan competition at the University of Chicago.
You won MVC?
We won the New Venture Challenge, which was kind of some external validation for what we were doing. We got a tiny amount of funding, relatively tiny, that gave us some capital, and then we got some press. We had a working prototype, so we had some momentum within Chicago, and there was enough there that it convinced my now co-founder to take the leap, leave the company he was working at, and join me full time. We also had a shared vision. There was commonalities in what we wanted to build, complementary skill sets. So he took a leap, and then I cultivated a relationship with another engineer at the University of Illinois that was wrapping up his PhD. He became our first hire. So they were the first full-time people on the team. We had a couple contractors, and then once we got into YC, we had a little more money. We went and hired a few more people, and then as the team grew, it kind of just built on itself.
Were you solo to study?
Yeah, I was. I had some classmates at the university that were helping, but none of them were full-time or planning to stick with the business. And then once I graduated, I was solo for a period of 3 months or so.
All right. Thank you, everybody. Appreciate you coming.
How are you?
Yeah, that was a good sort of
segue.
impromptu.